we started with the taxation of the business income. The topic is about taxation of the business income. And we say there are two businesses that we needed to look at. The first one is the taxation of the partnership, which we did cover. Taxation of the limited company was the second one. Under the limited company, we say there are various areas that we need to look at, actually 6. We talked about corporation tax, installment tax, taxation of the group of company, taxation of specialized company, compensating tax, and shortfall distribution tax. Now, we are at the taxation of the specialized companies, where so far we have been able to look at 3 specialized companies. That is, the first one was the taxation of the bank. The second one was taxation of the insurance company, taxation of cooperative society. So we look at the 4th specialized company. That is now the taxation of the petroleum company. And you can see it's not just a petroleum company. We are talking about taxation of petroleum companies and petroleum company service subcontractors. So these are 2 companies in the same sector that I want us to look at. So we start with the first one, being the taxation of the petroleum companies. What are these petroleum companies? The petroleum company we are talking about here is not about the company that normally sell the petrol or oil with the petrol stations. We are talking about the company that usually extract oil. For example, there is one in Kenya which we call Taro Oil. It's doing the extraction of oil in Turkana. So that's the one that you're talking about, the one that extract, maybe refine, and then sell the petroleum product. That is the one that I want us to look at, how it is usually taxed. Now, these are the points that you need to know about the taxation of this petroleum company. First, we look at the definition. So we have the points to note. Number 1. The first thing that we have done is to define, whereas we have said petroleum companies are companies involved in exploration, extraction, storage, and selling of the petroleum products. So petroleum products is anything that come out of the petroleum crude oil. For example, the natural gas, the diesel, any fuel in nature that is usually extracted from the petroleum product. So that is the one that I want us to look at. Point number 2. The next point that we need to know is that the petroleum companies are taxed on their taxable incomes, determined using either, like any other business, we either use the gross profit method or the net profit method. If you are given net accounting profit, net profit method. If net accounting profit is not given, then we use the gross profit method. That is point number 2. Point number 3. Yeah, so what we need to note that petroleum companies are companies like any other. So we need to determine the taxable income, and then we apply the corporation tax rate to know the tax that is supposed to be paid by the petroleum company. So we normally apply the corporation tax rate on what? On the taxable income. So you get the taxable income. If it's a resident company, tax it at the rate of 30. If it is an unresident company, tax it at the rate of 37.5 to get the tax that that company is supposed to pay. That is point number 3. Point number 4. We have an additional taxable income when it comes to the petroleum company. Since it is a specialized company, when you talk of additional, it means that other than the income that we said are taxable for a normal business, like realized foreign exchange gain, discount received, this is also a taxable income when it comes to the petroleum company. And you are saying this taxable income is additional any income from selling of the petroleum product. Petroleum product is what the petroleum company extract from the crude oil. It can be a natural gas, it can be diesel, it can be petrol. So when they sell and make an income, that is supposed to be an additional taxable operating income. Point number 5 to note about the petroleum companies. So we have the additional allowable expense for the petroleum companies. These are other than the normal allowable expense that we talked about under the normal business or general business. These are for the petroleum company and they are allowable. They are. So we are talking about one of the additional allowable expense is any expense relating to drilling of a well. These expenses are which one? You'll hear the them being named as. So all these are considered to be a drilling cost of a petroleum company. Geological, geophysical, and geochemical study cost. We have the cost of determining where the well is supposed to be located, cost of cleaning the well, cost of maintaining the well, and any other cost that is related to drilling of a well. You'll hear them sometimes being called intangible drilling costs. It doesn't matter. All these are supposed to be allowable expense. Number 2 of another additional allowable expense. So we are saying that any amount paid to the government in addition to the petroleum agreement, that sometimes you can find that the petroleum company, for it to operate in Kenya, they may enter into an agreement with the government that whatever income they get, some of it has to be paid to the government. That is supposed to be allowable. But this should not include the taxes. Taxes are paid by all businesses. So that tax is not supposed to be an allowable expense. This we said for any kind of a business. Point number C is the amount paid to petroleum company service subcontractor. When you talk of petroleum company service subcontractor, is any other company that is contracted by the petroleum company to help in the oil exploration. So when that company offers the service, it is paid for the service rendered. That is supposed to be an allowable expense. Number D, another allowable expense, it is the production expenditure. When you hear of production expenditure, these are the day-to-day expenses incurred by the petroleum company. So day-to-day, like salaries for the staff, communication expense, fuel for the machine, all these are supposed to be allowable expenses. Then after that we have E, another allowable expense, that loss brought forward from the previous years. That if a petroleum company made a loss in 1 year, this is pushed to the next year. And then next year, before you tax that profit, deduct that loss from last year. If you're not able to make profit in that year, carry it forward to the 3rd year, to the 4th year. And that is done indefinitely. And that is very important because you can be asked, for example, one of the incentives that the government has given to the petroleum company for investors to come and invest in petroleum operation is this one. They are told that you can carry forward a loss indefinitely as long as you are in the operation. Another allowable expense, in this case we have F. It is the commissioning and mobilization costs. This we normally say are the expenses that you incur to take resources to the well site so that mining of oil can start. Those costs that you incur, for example, to take machine there, to take the labor, the workers there, those are supposed to be allowable expenses. Then we have G, another allowable expense. We have what we call the commissioning and demobilization costs. Now, these are the costs incurred to take away the resources from the well site after you stop mining. For example, once you are done with mining with crude oil, and now you want to close that well, it can no longer produce any oil. In that case, you move your machine to another area. You move your workers to another area. That is what we call the commissioning and demobilization cost. And it is supposed to be an allowable expense. Another one, it is the cost of a well abandoned on failure to discover oil. A petroleum company can sink a well with the intention of getting oil. It incurs costs. And then it realizes that once they get down there, there is no oil. So they have to move to another area where they try to sink another well to look for oil. That well produces an oil. So what you are saying is that the cost that was incurred to sink the first well can be transferred to this one that has been sunk and produced oil. So before we tax the income from that oil, we deduct the expense from the previous well. Another one, we have the extraction or oil lifting cost. This is the cost that is incurred now to extract the oil from underground to bring it to the surface for the processing to start. Another one, so another one that we have there is what we call petroleum investment allowance, or called PIA. Now this is granted on these items that are directly used in the process of mining the oil. So we are saying we normally give them petroleum investment allowance at the rate of 50% in the first year of use, and then 25% reducing balance from the second year. So what I'm trying to say that only the name change. The concept is made the same as we talked about in the investment deduction when it comes to the manufacturing. So that is what we call the petroleum investment allowance. Then we have the last one, wear and tear allowance. Yeah. So when you have an item that qualifies for wear and tear, give it the wear and tear allowance like a normal business. So these are the additional allowable expenses when it comes to the petroleum company. Otherwise, the normal expenses that we say they are allowable for any business, they are also allowable for the petroleum company. So those are the points that you need to note about the taxation of the petroleum company.